to Healthy Outcomes, a venture case study from upstate New York. So I'm introducing Chris Rohde. He's the partner at Woods Oviatt Gilman LLP. David Brown, he's the managing director at Impellant Ventures, as well as Ken Rosenfeld, the chief operating officer at Agnomi Sleep. So with that, the floor is yours.
Thank you. Does everybody hear us? So, I'm going to probably jump right in a little more because the first panel was amazing and they really kind of covered a lot of this stuff about where things are going and where investors are looking at. But just a quick introduction. This is really, I think, a case study building on what they just talked about and Ken's company. I represent the company. David is an investor and on the board. So really wanted to just apply some of the things they just talked about and dig a little bit deeper into outcome-oriented investing and where things have moved from hype to outcomes. So, starting out there, I guess my first question to Ken and Dave would be, Dave, I hear you often use the phrase durable and enduring companies, and that's what you look for, durable and enduring companies. So, what have you done to ensure that that's what you're building?
Yeah, no, that's a great question, and I just gotta say I'm so happy to be up here. It's so much warmer than it is over there, and so you guys look very comfortable. So I'm gonna actually jump in a little bit on what the last conversation started with, just because I do think it actually is part of our thesis, but it's also interesting in the overall picture. My view is that hype in venture is not dead, and it's never going to die. What you have to understand is if you're looking at the fundamental of what's happened to venture since really 2000, the entire landscape of how venture worked from the early 2000s to today has fundamentally shifted. And what I mean by that is if you look at venture back in the early 2000s, there was not a lot of capital provision. There was not a lot of money to take companies all the way to being private till a $2 trillion valuation. Companies were going public at $100 million, $200 million, not of revenue, but of valuation, and that was a sustainable model. That's changed so dramatically because investors have found out that at the end of the day, you can make money in one of two ways. You can make money on performance or you can make money on assets under management. Well, it's much easier to make money on assets under management than it is to have really high performance, and so keeping companies public or private for longer before you go public has huge value. In terms of assets, in terms of being able to push things on. If you look at Andreessen Horowitz today, they have over $52 billion under management. That's $1.2 billion of annual management fees that these guys are raking in. And they don't even have to have performance. Now they get a 2X fund on top of that. Hey, world is really, really, really good. What I think we've seen in the last few years, in the 2020-2021 period, when we're in the end of ZIRP, capital was easy to raise. That obviously slammed into a wall, and these investors, rightfully, especially at the later stage, started realizing there is opportunity to start to create more circuitous capital diffusion. And so you are still seeing the pass the buck, fast entrepreneurship and hype machine, but it's all in AI, it's all in space tech, it's just a lot more concentrated. So what does that mean for companies like Ken and some of the stuff that we invest in, these durable businesses? There's less money sitting in the hands of smaller VCs and smaller funds to be able to do the Series A, Series B. And so you're seeing a dry up of that side of the pool. And that's why you're starting to see down rounds, people getting more crunched, less valuation control, because those larger funds no longer have to deploy into absolutely everything to try to find alpha. They're putting in some very calculated bets. This quarter was the highest VC quarter in history. But if you take out the top 5 transactions and you take out everything that's in AI, it's actually been a down quarter. And so this is happening. VCs continue to expand. It's just not happening to what we typically think of as durable businesses. And so for us, we really like these founders that are in overlooked markets, like what Ken is doing, and they're building bread and butter businesses, things that are not sexy. But if you think about the long-term viability that this last panel talked about with profitable businesses, things that have capacity to stay around for the long term, that requires a business that can grow at a healthy rate. It could be astronomical, but it has to get the fundamentals right before you really start to expand.
So Ken, what have you learned at Ognomy about resilience, durability? How have you applied that at your business?
Well, first of all, it's kind of fundamental with what we do. And just to quickly introduce you to Ognomy, we are a platform that's driven by automation and some AI as well that's focused on patients that might have sleep apnea. So we help them get seen, tested, diagnosed, and treated, and then continue to support those patients through the therapy journey. And as far as this being durable, it's a big problem that has not been solved because there are 1 billion people worldwide who have sleep apnea. There's over 50 million people in the US who have sleep apnea, and 80% of them are undiagnosed. And the downstream effects of undiagnosed sleep apnea, or OSA, obstructive sleep apnea, is significant, and it costs the healthcare system, and it impacts quality outcomes and so many aspects, mental health, and you can imagine, your partner snoring next to you. So, from that standpoint, we have a business that is in an area that is durable, right? It's a problem that's not going away. In fact, it's only increasing. By 2050, there'll be 75 million people in the U.S. who have sleep apnea. So that's been really part of it, and it has been our focus, but you can't just have the problem that's not going away. You need to be thinking about how you're going to build a company that's going to address that problem in a sustainable way. And so focusing on gross margin and being efficient with gross margin. I can't tell you how many times from a standpoint of working with prospective investors that gross margin has been one of really the key aspects that has tilted a decision one way or another. And we have to go up against SaaS companies that have huge, very high gross margins, and we're a tech-enabled services company that has lower gross margins. But by golly, if we get over 55% gross margin, that's great for our type of business. So continue to focus on gross margin efficiency and how we apply technology to make sure that continues to actually grow, as well as looking at all the paths that you're going to be getting revenue from these patients and accessing those patients that are undiagnosed, and looking at multiple channels to drive that are all things that really contribute from our perspective to a durable company.
So you talk about capital efficiency there and gross margin. David, what are the other things you think about and look at when you really start to focus on capital efficiency, which is really kind of a key concept to this outcome-based investing?
Yeah, no, it's a great question. It actually, I think, hits kind of how the last panel ended, right? Is like, what makes an investable company at different rounds? If you're going to do Series A or B or otherwise. We come in at the pre-seed and seed, and so we're very much betting on the founder and the ability to figure out. That's why we love these guys, is they've spent, we've been with you for 4 years, and you have figured it out, and it's taken a lot of elbow grease and a lot of hard work to really figure out. And you guys are going to hear great news from them because there are some great things on the horizon right now. But for us, right, I think fundamentally, what you're seeing is it's not just revenue. It's never been just revenue, but it's shifting a lot more to some of the things that Danielle was talking about and Flossie were talking about in the last round, right? Like, what are your user traction numbers? How are people what is retention looking like? Are you losing customers through the pipeline? What is tough in venture is there's always this push to go incredibly fast, and time value for money is everything. And so if you don't hit that next stage within 2 years, right, the hype cycle, quote unquote, of 18-month cycles to get you from one round to the next round, you are trying to squeeze everything out of every dollar. And what I always say is money helps accelerate good ideas, but it also helps compound really bad ones. And so if you are rushing from one stage to the next, but you haven't got your fundamentals correct, and I mean, Ken, we can talk about this. If you guys had tried to raise your Series A, which we wanted to do 2 years ago, it would have been a disaster because the fundamentals weren't there, right? You have to figure out how to reduce the churn. You have to figure out how to do customer acquisition correctly. You need to know what your channel pieces and sales are looking like. And so getting the fundamentals right before scale is so important. Then so many people miss that as they're thinking about where they want to go. And so I always say, when you're thinking about what you need to do from an A, B, C round, for us, right at the early stage, it's, are you a good entrepreneur? And are you gonna go figure this out, and are you gonna work your ass off to make sure that happens? When you get to the Series A, Series B, growth, it's saying, have you proven in a demonstrable way that what you're doing is repeatable? And the Series A says, can we take it from repeatable in upstate New York to repeatable in Boston and a few other ecosystems? Series B says, can we now take that through to the rest of the country and start going international? Series C starts to say, okay, what other sectors does this look like? How do you start to think about the expansion outwards? And so you really need to think about your development cycle as a pathway to how do you develop the fundamentals that allow you to scale efficiently.
So, question for both of you. We focus on efficiency, gross margin, but where is it okay to spend the money? Where is it okay to be over, or to be inefficient, to overinvest? Where in your minds, and maybe specifically Ken at the company, where is that still okay to do it?
Well, I think we're continuing to learn that, to be honest. And I think there's, for us, one of the big pushes as we move forward is actually our data, because we're actually adding value to this whole process. We're getting great results from a healthcare perspective. We're getting our patients to be 80% compliant on CPAP machines, for example, where the industry's at 45%. And we're trying to unlock the reasons why, and to be able to then double down on that, and to be able to show the industry that we can get better health outcomes and lower the cost to healthcare overall. So investing in that technology and that data and that infrastructure, because we're already seeing the data that's very positive. Now, how can we accelerate based upon the intelligence we derive from that, I think is certainly something that could be, if you say over-invested, and I think it's simply investing in it, right? Because that's what's going to help drive the future of what we're able to do and grow the company significantly as a result of that.
So maybe it's not so much inefficient investing as much as longer term investing. Right. So maybe David, how do you as an investor balance that question of, okay, we want to see the returns, but we acknowledge that sometimes those returns are going to be a little more speculative, a little longer term. Mm-hmm. How do you deal with that?
Yeah, I mean, that's why I think this discussion around which fund you're talking to is so important. We're designed to be 10-year funds, right? We expect each of our relationships to take 8 to 10 years to really work its way through. As you get later stage, those might be 3 to 5 years. Actually, one of the things I hate is when I get an entrepreneur who comes in and they pitch us and like, this is amazing, we'll be out within 3 years and you're gonna have your 8 to 10x return. I go, that's awesome. Sounds like a great return. Doesn't match my profile and I don't have the capacity to reinvest it. So that's not as good for my investors. That's not as good for me for compounding. I want to see a bigger vision, a bigger opportunity than that. And so you have to kind of think about that mix against what your entrepreneur is doing. I would say one of the things that we're happy to fund all day, and this is where we evaluate a lot of our entrepreneurs, is your capacity to make and test assumptions. I always say I love seeing entrepreneurs, and this is, you guys can use AI for whatever you want. Don't use it for your numbers, or at least only use it to help implement it. Because at the end of the day, your numbers tell me what your assumptions are. And a really good founder is like a scientist. You might not be a scientist, but you want to use the scientific method of saying, here are my theses, here is what I'm trying to figure out. As we test each of these pivot points, what does that tell me on my decision tree? If this is going positively, do I go this way or do I go that way? And so a really good founder for us, and what we love to see Ken and Dan and their team do, is test things small. Get enough information so that it's statistically meaningful to what you guys are doing and your numbers and your company, but don't overinvest until you have real data. It's always the classic mantra, build something that doesn't scale so that you can scale once you know what the real answer is. AI allows you to get to a scalable product quicker, but you're still going to have to go through multiple iterations. And so don't spend your time, energy, resources on building something until you have validation, and use your capital, particularly early capital, judiciously, because burn doesn't happen when you take in money. Burn happens when you spend it inefficiently on the wrong things and you double down too expensively on, to say crass, dumb, right? When you do something the wrong way for too long.
I want to add to that same topic, because there's another area where we're continuing to evolve and mature as a company. And part of that was actually the revenue accelerator that we did here at Golisano too. And, one of the key aspects of that was working out what the playbook is in order to grow the company. And it's totally a test it first type of approach. You're looking for how can you build revenue with the lowest possible investment and lift by looking at what really is your low-hanging fruit. One of the examples is we're on Lilly's website. Zepbound, which is a GLP-1, was indicated for the treatment of sleep apnea, and Lilly put us on their website as a telehealth provider for sleep apnea. So it's great, we're getting all these referrals from Lilly, but part of that is understanding, okay, well, if they come through and they never get care, let's say, well, let's look into that. Here we have people already coming through our digital front door. How can we look to increase conversion? How can we look to build on what's already happening, which can be done at a much more cost-effective rate than just trying to send a whole bunch of salespeople out to try to build a channel that's brand new. So it's all about getting that experience, building those playbooks, proving the playbook, and then you can start to replicate and invest on something that's proven.
So, in your experience with Lilly, what were the lessons that you learned there about, diversification? Tell us a little bit about that. And I know there were some speed bumps, there were some lessons learned. I think it's overall a great success, so I think it'll be nice to hear about.
Well, we're very happy to be on Lilly's website, but it was a really interesting lesson to learn too, and talks about kind of diversity of those revenue channels. Because Lilly said in mid-June of last year that they were going to do this massive campaign. They're going to spend all this money promoting Zepbound for the treatment of sleep apnea, and it didn't happen. And then it was going to be September, and it didn't happen. And then there was going to be, a big push starting the beginning of this year, and it kind of started to happen. And now they have Shaq as an ambassador, and he's on TV promoting Zepbound. And it's great, but it's not even close really to what they were originally kind of sharing as the volumes that we would expect to come from that type of collaboration. Don't get me wrong, we love our partnership with Lilly. They're actually a great company to work with. But it's also a lesson that it really diverted a lot of our energies and our resources. So part of that spend allocation is being more deliberate and more careful about how we spend our limited resources and working on having multiple channels that can provide that durability. So if one channel slows down, we have another channel that's speeding up, right? And we can weather the storm, if you will, if one of those if we're just subject to whatever their whims are on their marketing budget, for example.
So kind of tying this all together, you mentioned earlier Series A, and you've been kind of looking at more active fundraising now. So how does being in a fundraising mode versus not being in a fundraising mode change your view on these things, on efficiency and metrics and management of the company in general? Once you start go into a fundraise, what changes? What do you look at differently?
Well, it really is a crucible, right? It forces you to look really hard at what your plans are, what you've already shown, how you're going to build on it, and how you're going to focus what you're doing moving forward, and that you have a believable story that's based upon what you've done before, what you've learned, that you can really scale this company. So you're in a crucible. You have to run your business and you have to deal with the fundraise all at the same time. We have a consultant that David knows, and he says, like, this whole process, his first words, it's impossible, right? You're doing something that's impossible here to try to do all this stuff and do it well. But, so it's a challenge, but it's also an opportunity because it did help us really crystallize our focus on what our plans were to scale our company and to be able to communicate that story very effectively to these investors.
Ken, I want to push on you a little bit because you guys will find it. They just raised it, almost done with an unbelievable Series A that's going to be great for the company, great for the region. But one of the things, the consultant that we had him working with the Vishal, had them really focus on is at the end of the day, when you get to the fundraise stage, this is a 24/7 game for weeks, months on end, and your life changes. And a lot of entrepreneurs, these guys included, kind of looked at it at the beginning and said, okay, cool, Series A, let's go. Who do we start talking to? And Vishal story, because once you get in front of the investor, timing, execution, repetitiveness of what you're saying is so important, and you have to have everything ready already, because if you know.
Well, you have to be humble. You have to be humble, you have to be willing to learn, you have to be willing to accept this input. The other thing is you can get a lot of input, and sometimes the harder part is figuring out what input you want to, focus on. But it's a massive job. It's a massive job because we're growing our company, and and the interesting rub on it is that not only is it a massive effort to kind of get this and get the story right and make sure you're building the company, you have to keep building your company. You can't let that stop, right? And so there's even more focus on the metrics. It's like everything's open to these guys, right? They're looking at everything.
The last 3 months before you raise are almost the most crucial part of that raise, right? And so if that raise goes on another 2 or 3 months, you don't get to have those numbers go back down.
Right, exactly. So you have to put your 100% focus in, 10 different areas. So you're working at 1,000%, trying to do this. But with some good, we got help, and it was very good help, and it really helped us crystallize the message. It helped us crystallize our plan. And we've been able to keep those balls mostly up in the air, and hopefully very soon we can make some, share the great news. We're almost there, so I don't want to jinx anything, but it made all the difference to be able to get that really good input. But it's a major effort.
So you had to create hype at the end of the day.
Yeah,
right?
we do. You have to be able to. I don't know if I call it hype. You have to be able to tell your story.
Correct.
It's about the story, and it's not just slides in a pitch deck. It can't be. And our CEO and founder, Dr. Rifkin, he went through a lot of, sessions and training as well to be able to crystallize that story and tell that story. The beauty is we have a great story that's very honest and humble and dealing with a major problem in healthcare today. So that helps. But no matter what, you still have to really have a crystallized, effective story to tell.
Yeah, I think that's seeing a lot of these deals and kind of being in the middle between the investors and companies. It's something you miss. You hear the hype versus outcome, but there's a difference between hype and a story. And you still have to have the story. It's not all numbers. It's not all metrics. You still have to have that story that you can sit down in a room and sell, and then back it up with the metrics. Now, I think the metrics are backing up your story. They're not replacing your story.
Well, I'm glad you say that, Chris. One of the beauties, Chris will be too humble to tell you himself, is one of the things of great lawyers, they'll tell you what you can actually say too, and make sure you say the correct thing so you don't get yourself in trouble down the line.
Yes, and I generally he listens.
Did you point to me or Ken?
Just generally waving in that direction. How are we doing with time? Are we okay? One quick question. I wanted to. You talked about scaling, and the prior panel talked a little bit about where we're at regionally, and maybe before we get to the end here, just get your thoughts on. Is being here, Rochester, Buffalo, Western New York, Upstate New York, does that make scaling easier or harder, or how? In what ways? Or can really
it really is both. Yeah, and I think we heard that from the prior panel as well. Look, we're trying to be capital efficient, and being in this area helps us do that. We're we're a virtual company, but we have a lot of people in Buffalo that are in our patient support area. We are, because we're a virtual company, we can get great talent from really anywhere. But, you know, being based here helps us do things fairly cost effectively. And we have some great talent in the, you know, in the area. There's no question about that. Fundraising takes more effort. It absolutely takes more effort. You have to go out there. So this is my third digital health company. In the major rounds of each company, and now hopefully this next one, they're investors from elsewhere who are coming in to do this.
Yep.
Right? And my prior company was Kasana, and the big round General Catalyst came in, and they're an amazing VC firm, but certainly one of their, I don't know if they, you know, very few or maybe one or two investments in this area, right? I mean, it's you have to go and get it.
Yeah, they're both Austin, right? So,
Yeah.
yeah. I mean, I think the answer for me is yes and yes, right? Like, part of the reason I love investing in these ecosystems is because there's an untapped capacity, right, that doesn't exist other places. What's tough about being in these ecosystems is you have to be willing to run that much harder. You're not going to have your best friends as the investors who are going to rate the next round, right? And even when we were in Boston, you know, I moved back here from Boston, that was not the case. You had through Series A, but Series B, C, D, you still had to go over to the West Coast. I mean, we were talking with Ben Horowitz not that long ago, and he, you know, jokingly referred to New York City as a really nice frontier market, right? That's the world we're living in. The thing that's so great, though, is when you look at Rochester, Buffalo, Syracuse, Ithaca, any of these areas, our diaspora is everywhere in these ecosystems. Like, it drives my business partner nuts. We'll go through Boston, I'm like, oh yeah, no, this is a great Buffalo guy, and he's like, why do you refer everything back to there? I was like, because it's like you start mentioning it, and it just kind of hits everywhere. Like, the capacity and the tentacles of our ecosystem outwards are so much deeper than I think a lot of us actually give credit for. And it's actually what's making us so strong now is the boomerangs coming back from all over the country and imparting value and relationships here. The piece there are two things that I think that are tough here that we need to continue to stress, and if we continue to do that, we're going to actually take over the world. One, we're too geographically spread out, not just city to city, but even within our own cities, we need to push together more often and come together. And then we got to figure out our flights. If we can actually fly places, you know, it makes life a little bit easier. But, you know, those are small wins that, you know, the more we create, the more it's going to fall in line. So.
Okay, so final question. That's all talking about outcomes. You know, for each of you with Ognomy, what's a great outcome? Somebody says, what would be a great outcome for you with this company? What's your answer?
Proving, first of all, that we can be a durable company that continues to scale. You know, from our perspective, we're looking to double revenue this year from last. We're continuing to increase our, you know, gross margin like we talked about. But for us, we're looking to be a category leader in the sleep space. So getting to that category leadership is absolutely a great outcome. So having a great company, it's not about a particular exit or a particular type of exit. It's about achieving that category leadership.
Yeah, I've got two answers to this. One is what I should be saying for my LPs, right? And that is that we have $1 billion outcome, and, you know, our fund is returned 100 times over. And that actually is one of the things that we fundamentally have to do. And I appreciate all the support that we've had from our LPs and fighting hard to make sure that these guys get to those sort of results. The reason I invest is because fundamentally, nothing makes me happier than seeing an entrepreneur succeed, right? And I can still remember the first conversation I had with Doc Rifkin 5 years ago when he was starting Ideate and nobody else was paying attention to him. And he said, hey, we just want to create something of value. Sleep apnea affects so many people in the US, and 80% are undiagnosed. And, you know, someone's got to solve this, and I'm doing from the clinical practice, but I can't do that at scale, and I want to figure out how to really do that at scale. And then I sat down with Dan, and he had just left, Ken, and he had just left Kasana, and he's like, hey, I just want to find a company I can spend my life dedicated to creating real value for people and patients and, you know, have outcomes that matter. And, you know, as soon as I heard that off Ken, I go, hey, you got to meet this guy, Dan, and you guys are going to have a blast. But for me, if I can see these guys hit even a tenth of what they had of vision originally, and by the way, what vision is today is even farther than what they started with, I'm gonna be so proud of these guys, and that's what matters. And if they can create an enduring business that isn't sucked up to a different part of the country, but continues to hire and employ and continues to grow our region, that's gonna be huge. But what I care about even more about that, past that, is after they're done, if they continue to give back and continue to mentor and support the next generation, that's what's gonna be the real circuitous win that we're all looking for.
Great. Appreciate it. Thank you. Any questions?
And everyone's wondering, it did get cold up here again, so that's why I'm shivering. I know, I
A
got
lot more people in the building tomorrow, so they're probably getting prepped for that. But thank you again to our panelists for a great discussion. This was fantastic, and I wanted to give you back a little extra of that time, but, you know, good conversation. We want to go where the river flows, right? But again, thank you all for being here tonight. The reception, we're going to follow back in the room. Tomorrow, the program is going to start again. Registration is at 10 a.m. and we are going to be in the Revenue Accelerator, which is right next to where the reception is. Tomorrow for the morning part, and then at 2:30, we all reconvene in this room. We're going to hear some great speakers, student pitches, and then we're going to see who the winner is of the New York State Business Plan competition. So really exciting. But